All right, Bruce, with Onward Mortgage, rate cuts, but rates go up. Tell me a little bit about how that scenario can play out.
Well, this is a question I get a lot from clients, and it confuses a lot of buyers why mortgage rates might move up after the Fed cuts rates instead of going down.
Right.
And the main key here is the Fed doesn't directly control mortgage rates.
Right.
Mortgage rates are tied to the bond market, especially mortgage-backed securities. And those markets move based on inflation expectations.
Yeah.
Inflation is a word we hear a lot.
Yeah.
When the Fed cuts rates, it sometimes sparks fears that inflation will head back up or heat up, and that the economy is probably stronger than expected. If investors think that inflation will rise, they demand higher yields on bonds, and then mortgage rates follow those yields, right? Makes sense.
Yeah. And that 10-year treasury is kind of the mark. Like, if people, you don't really look at the Fed rate, you look at what the 10-year treasury rate is. And so if the Fed chooses to buy mortgage-backed securities, right, then that will naturally bring down, like they did through COVID. They bought tons of mortgage-backed securities and increased their balance sheet like crazy. And that's what took rates down to that 2% range, that 3% range on a consistent. They're wanting to do the opposite now, right? They're shedding mortgage-backed securities. They're trying to reduce their balance sheet. So it's going to take something like a pandemic or something like that. Again, none of us want to go through that in order to get to a 2% interest rate, right? So, yeah.
No, and that's spot on. And I would say that's exactly kind of what we saw with the last cuts, right? Fed cut, everybody thought rates would come down.
Right.
They did the exact opposite.
Yeah.
Instead of celebrating, the bond market reacted with caution, kind of priced in the risk of future inflation. So what happened was the opposite. Rates actually climbed after the last few Fed rate cuts. Right. So the bottom line is the cuts don't guarantee lower mortgage rates.
Right.
It's not direct. So what matters is really how investors take the anticipation, the Fed's move, and especially the context of inflation, which is that word that we hear a lot. Though inflation's settling, it doesn't necessarily mean that rates are going to come down after a rate cut.
Yeah, I see a lot of people like, oh, we'll see what the Fed says. We'll see what the Fed says. We'll see what the Fed says. Well, the Fed makes a decision, and actually the rate is the reaction to the decision, not the direct correlation from the decision, right? And so I think that's just important for everybody to know. It's a nuance. I never thought growing up we'd be talking about Fed fund rates, as a consistent conversation that takes place within my profession. It's kind of funny to see how that goes. So if you hear the Fed drops rate, don't think naturally that means mortgage rates are going to go down. Right?
Yeah,
that's the bullet point.
And these are typically baked in well into advance. So when you have a Fed meeting come up, the market's reaction to what they think is going to happen with that cut has already been baked in.
Right.
It's not a natural effect, cause and effect. So when they cut it, it doesn't mean that's going to have any impact directly, but you will see that impact happen up until.
Yeah, the only real impact on the announcement would be if it's something outside of expectations, right?
Yes.
Right.
Yeah,
So,
quarter expectation, a half a cut, that moves the markets because they weren't anticipating that. They didn't price in that extra 0.25%.
Yeah, exactly. Well, if you guys have any other questions about how this works, go ahead and reach out. If you like this content, like the video and go ahead and subscribe. Thank you.
Thanks.